Most people are misreading XRP right now. While the price has been falling, some of the largest participants in the market appear to be increasing their exposure, creating a divergence that investors rarely ignore for long. Today, we're going to examine the whale accumulation data, institutional inflows, regulatory developments, and macroeconomic forces that could help explain why smart money appears to be positioning very differently from the crowd. The first thing you need to understand is that price and positioning are not the same thing, ladies and gentlemen. Price tells you what happened. Positioning tells you what investors believe could happen next. And right now, those two signals appear to be moving in opposite directions. Over the past several weeks, XRP has experienced significant downside pressure. Retail sentiment has weakened. Fear has returned to the market. But beneath the surface, a different story has been developing. Large XRP holders have continued accumulating. Millions of XRP have been moved off exchanges. Institutional investment products have continued attracting capital. And that's where things start to get interesting. Because historically, some of the most important market turning points begin with a divergence between what price is doing and what capital is doing. Write that down. The question isn't whether XRP has fallen. Everyone can see that. The real question is why larger participants appear increasingly willing to accumulate while most of the market remains focused on the decline. To answer that, we need to look beyond the chart and examine the structural changes happening across crypto, regulation, liquidity, and institutional adoption right now. The institutional playbook: institutional investors rarely buy when headlines are positive. That's their playbook, ladies and gentlemen. They've been following that forever, and that's one of the first things I learned on the floor of the New York Mercantile Exchange. They buy when uncertainty creates opportunity. History has demonstrated this repeatedly. The largest fortunes in financial markets are rarely created by following consensuses. They are often created by identifying structural changes before the majority recognizes them. And that's where XRP becomes interesting, because today's conversation is no longer just about speculation. It's increasingly about infrastructure, payment infrastructure, settlement infrastructure, liquidity infrastructure. And institutions care deeply about infrastructure. They care about systems that can move value efficiently. They care about regulatory clarity. They care about custody. They care about compliance. These factors often matter more than temporary price action. Short-term noise, long-term structure. That distinction may become increasingly important over the next several years. Quick disclaimer: this content is for informational and educational purposes only, not financial advice. Never invest based solely off of YouTube videos. With that said, let's continue. I want you to think about the railroad revolution. In the mid-1800s, investors viewed railroads as highly speculative. Many projects failed. Capital was destroyed. Critics argued that expectations had become unrealistic. But beneath the volatility, something far more important was occurring. The transportation infrastructure of an entire nation was being built. Those railroad networks ultimately transformed commerce, logistics, trade, and economic growth. The biggest opportunity wasn't simply that trains, it was that infrastructure. Today, some analysts see a similar dynamic developing within digital finance. The debate often focuses on token prices, but the larger question may be whether new financial infrastructure is being built beneath the surface. If that infrastructure gains adoption, the implications could extend far beyond short-term price movements. And XRP sits directly within that conversation. Of course, XRP does not exist in isolation, ladies and gentlemen. Bitcoin remains the dominant force in crypto. When Bitcoin weakens, risk assets across the sector often experience pressure. When Bitcoin strengthens, liquidity follows flow throughout the ecosystem. This relationship has existed throughout multiple cycles, and today is no different. Many analysts believe XRP's long-term upside scenario depends heavily on Bitcoin continuing its broader adoption cycle. Not because XRP depends on Bitcoin from a technological standpoint, but because capital flows matter. Liquidity matters. Market psychology matters. If Bitcoin enters another major expansion phase, Over the coming years, history suggests alternative digital assets could benefit from that environment. That does not guarantee success, but it creates conditions where larger moves become possible. And that brings us to the bigger macro picture. Every major asset class ultimately responds to liquidity. Stocks, real estate, commodities, cryptocurrencies, all of them. Liquidity acts like fuel. Without it, markets struggle. Within it, markets continue to expand rapidly. Today, investors are closely monitoring central banks around the world. Many policymakers spend years tightening financial conditions to combat inflation. But the conversation is beginning to shift. Some economists believe future monetary conditions may become more supportive for risk. Others remain cautious. The outcome remains uncertain. But here's where it gets interesting. Crypto historically performs best when liquidity expands rather than contracts. If global financial conditions improve over the coming years, digital assets could find themselves operating within a much more favorable environment than they have experienced recently. And XRP could be one of the beneficiaries. If you're enjoying breakdowns like this, make sure to like and subscribe. Join the Wolf Pack. It helps the channel out a lot. Now, with that said, let's continue with today's business because this next part is where it gets more interesting. See, for years, regulation represented one of XRP's largest obstacles. Institutional investors dislike uncertainty. Large funds cannot allocate billions of dollars into assets facing unresolved regulatory questions. That's simply how risk management works. But the environment today looks very different from previous cycles. The legal landscape has evolved. Legislators are discussing frameworks designed to provide greater clarity. Policymakers increasingly recognize that digital assets are becoming part of the global financial system. That doesn't mean all uncertainty has disappeared. Far from it. But compared to prior years, the direction appears significantly more constructive. And institutions notice these changes long before retail investors do. Because regulatory clarity is often the foundation upon which institutional participation is built. Without clarity, capital waits. With clarity, capital moves. I want you to think of the creation of SWIFT in 1973. Banks around the world faced the problem. Cross-border communication was slow, inefficient, fragmented. Global finance needed a standardized messaging system. That challenge eventually led to the creation of SWIFT. At the time, few people viewed financial messaging infrastructure as exciting, yet it became one of the most important systems in the global banking system. See, today, some investors believe digital asset infrastructure may be entering a similar phase. The technology itself receives attention, but the larger story may involve how value moves between institutions. Whether XRP ultimately becomes a major participant in that future remains uncertain, but it's increasingly being evaluated through that lens, not as a speculative token alone, but as infrastructure. The whale accumulation nobody sees. Let's return to one of the most important signals, accumulation. Large holders have continued increasing exposure despite market volatility. Why does this matter, you might be asking? Because large participants often possess longer time horizons. They're not focused on net week's price action. They're focused on where markets could be years from now. That doesn't mean whales are always right. But when accumulation diverges dramatically from public sentiment, it deserves attention because whales are not always right, especially when it concedes with growing institutional activity, especially when assets are moving off exchange, especially when retail participation appears fearful. These are the kind of divergences macro investors monitor closely because major turning points often begin when positioning changes long before price reflects them. Price is reacting, the system's evolving. I always tell everybody here to pay attention to what's quiet. Imagine standing in a medieval city watching workers build a massive stone bridge. Construction takes years. Progress appears slow. Critics argue it costs too much. Blah, 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 blah. Others question whether it's necessary. Yet once completed, the bridge transforms trade across an entire region. The bridge itself wasn't the opportunity. The economic activity enabled was. Some analysts believe digital asset infrastructure could follow a similar path. The market often focuses on short-term speculation, but the long-term opportunity may emerge from what the network enables, ladies and gentlemen, not merely from what it's today. Another important factor involves ecosystem development. See, infrastructure continues expanding, enterprise participation and partnerships continue growing, stablecoin initiatives continue advancing, institutional custody discussions continue progressing. These developments rarely generate the same excitement as price spikes, but they often matter more because sustainable adoption typically emerges through utility, not hype. This is one reason professional investors frequently separate speculation from adoption. Speculation can drive temporary moves. Adoption creates long-term demand. And investors increasingly appear focused on whether XRP, the anointed one, can participate in real-world financial activity rather than simply attracting speculative attention. That distinction could become critical over the next decade. Consider the construction of a modern airport, ladies and gentlemen. During construction, many people focus on the costs, the delays, the uncertainty, the inconvenience, but investors focused on the long term often evaluate something very different. They evaluate future traffic, future commerce, future economic activity. The airport matters because of what eventually flows through it, not because of the concrete itself. Likewise, some investors evaluate XRP through the lens of future network activity, cross-border payments, institutional settlement, liquidity provisions. The question isn't simply what XRP is worth today. The question is what role it could potentially play if adoption expands significantly. Can XRP reach $30? Now we arrive at the question everyone is asking. Could XRP actually reach $30? The honest answer is that nobody knows. Anyone claiming certainty is selling certainty, and markets don't work that way. However, scenarios can be evaluated. For XRP to approach that level, several conditions would likely need to align. A favorable Bitcoin cycle, improved liquidity conditions, continued regulatory progress, growing institutional participation, expansion of payment infrastructure, broader digital asset adoption. None of these outcomes are guaranteed. Each carries risks, each carries uncertainty, but collectively they form the foundation of the bullish thesis. The important point is this. The $30 scenario isn't based on one catalyst. It's based on multiple structural developments occurring simultaneously. The risks investors cannot ignore. See, every investment thesis has risks, ladies and gentlemen, and XRP is no exception. Bitcoin could weaken, global liquidity could contract, regulatory progress could stall, adoption could take longer than expected, competition could intensify, markets could remain irrational for longer than investors anticipate. These risks are real. Professional investors acknowledge them. They don't ignore them. The goal isn't certainty. The goal is evaluating probability and understanding whether potential rewards adequately compensate for risk. That's how institutional capital thinks. And it's how individual investors should think as well. The most important story surrounding XRP may not be the recent decline. It may not be the daily volatility. It may not even be the next major headline. The biggest story could be the gradual construction of infrastructure, regulation, institutional access, and market structure happening beneath the surface. While retail investors focus on price, larger participants appear increasingly focused on positioning. And history teaches us something important. Major transitions rarely look obvious while they're happening. Only in hindsight do they appear inevitable. Whether XRP ultimately reaches $30 remains uncertain, but the structural foundation supporting that possibility appears stronger today than at many previous points in its history. Short-term noise, long-term structure, prices reacting, the systems evolving. And that may be the most important signal of all. If you've enjoyed this analysis, subscribe, like, join the Wolfpack, share your thoughts below, and stay focused on the data, the macro trends, and the structural shifts shaping the future of digital finance. Because sometimes the biggest opportunities aren't the ones the crowd hasn't noticed yet. Ladies and gentlemen, I always tell you, pay attention to what's quiet. Hope everyone's having a great day today. A lot of things to go over. Real fast, I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel, all the new members of the Wolfpack. Remember, ladies and gentlemen, one good tip from the pits can easily pay for your entire year subscription if you're looking for the deeper macro research and how to take advantage of all this, come and join over 570 active traders and investors in the Crypto Public Desk Monthly. If you want to learn to invest, if you want to learn to trade, if you want mentorship and your hand held, do come and join the Crypto Public Desk Monthly inside the Patreon. It's a lot of interesting things happening right now in the market, ladies and gentlemen. I want you to understand something. When I started on the floor of the New York Mercantile Exchange, I actually despised it. I thought it was like a punishment. 15 years old, having to take the Long Island Railroad, and then the subway, and then get hit in the head with cards all day. To me, it was like some form of punishment. I look at that as a blessing now. I do. I look at it what I was taught. I was taught pressure. Pressure is the greatest force on the planet. It turns coal into diamonds. The market's in a pressure keg right now. I look at patterns. It's difficult to talk to retail, and this is the only retail that we talk to here, ladies and gentlemen, because the things that retail pays attention to, their concerns, their objectives, their goals, their time horizons are vastly, vastly different than institution, sovereigns, funds, nameless money. It's very different. I tell you all the time, the Asian Open is most important. We pay attention to the Widowmaker. The DXY is the most important compass that we pay attention to always. If it doesn't get above 100.20, it's going to drop to around 98 and change. That will take pressure out of all the markets. The metals should rebound from that. But again, a lot of the fluff has been taken out of the markets right now because traders got to make their weekly, their monthly, their quarterly numbers. That's what I'm talking about always. As the remora, we are underneath the apex predator, ladies and gentlemen. I want to start with a pattern most investors ignore until it's too late. See, every major gold cycle doesn't end with a collapse. It ends with confusion. Confusion about whether the trend is over or just resetting. See, we saw it after 2011. We saw it again after 2020. And right now we're seeing it again after a historic run from 2022 into early 2026, where gold surged over 200% before peaking near 5,500 region. And now the question dominating the market is deceptively simple. Is this a correction, a consolidation, or the start of something deeper? Because depending on how you answer that question, your entire 6 to 12 month macro outlook on gold changes. So what history actually tells us. See, if we throw out emotion and we go straight to structure, gold does not move in straight lines, ladies and gentlemen. Okay? Write that down, drill that into your head. After the 2008, 2011 move of roughly 170%, gold didn't immediately crash. It spent years digesting gains, falling roughly 37% into the late 2015, 2018 lows. A lot of people got cut up like sushi. After the 2018, 2020 rally of 74%, gold corrected roughly 22%, then consolidated again before resuming trend. None of this is financial advice, just my own opinion and retains any capacity. You have to understand this. If you look at the 2022 base to the 2026 peak, gold advanced roughly 245% in under 4 years. That matters because historically smaller bull runs lead to shallower corrections. Large accelerated bull runs lead to deeper, longer consolidations and speculative extensions. See, violent repricings when macro shifts. Right now, gold has already retraced roughly 20-25% from the highs. So depending on the pricing model that you're looking at, that's big. But here's some of the key takeaways and insights that we're looking. See, relative to the prior cycles, this is still a controlled reset as far as we're concerned in our opinion and retention capacity, not a structural breakdown. So the first conclusion is simple. We're not in a collapse phase. We're in a decision phase. And if you want to really look at what drove the last rally, see, we think that's very important. Most people simplify gold into one narrative, inflation hedge. But that's not what drove the 2022 to 2026 expansion. Three forces aligned simultaneously. Central bank accumulation, Central banks were buying at historically elevated levels, often exceeding 200 to 300 tons per quarter during peak accumulation phases. That's not speculative demand, ladies and gentlemen. That's reserve restructuring and the global financial world changing. Physical demand, number two, then exhaustion. China and India absorbed massive inflows during the early phases of the move. But as price accelerated, Chinese jewelry demand dropped over 30% year over year. Indian demand declined nearly 20%. Global jewelry demand fell sharply as affordability broke. This is important because physical demand does not vanish. It gets priced out. 3, financial fear premium. ETF inflows surged during uncertainty phases, but recently fell more than 70% year over year in some quarters. Meaning the fear trade has cooled, not disappeared. So what do we learn? Gold's rally was not driven by a single pillar. It was driven by a convergence of 3 macro engines moving in sync. When that happens, reversals don't need crashes. They only need one engine to slow down. So if you want to look at the real driver now, it's monetary policy exceptions. This is where most analysis break apart because gold is no longer primarily trading on physical demand. It's trading on rate expectations again. Let that sink in. Write that on the wall. Gold behaves like a non-yielding macro barometer. So when markets price tighter monetary conditions, gold compresses, loses expectations. Gold expands. Write that down. Uncertainty in Fed credibility leads to volatility spikes. We saw this exact structure in 2022. Gold initially surged on geopolitical shock. I'm going to tie this into XRP, so stay with me. I'm taking the PhD right here. See, the Federal Reserve tightened aggressively, and gold corrected for months despite strong physical demand. Why? Because paper markets dominate short-term pricing. So you have to look at the comparison critically of 2022 to now. In early 2022, Ukraine war triggered risk-off flows. Gold rallied sharply, then Fed tightening reversed momentum. So today, markets are again pricing the possibility of sticker inflation and delayed easing cycles. And gold is reacting the same way, not collapsing, but repricing expectations. So the real question becomes, is the market overestimating tightening risk or underestimating inflation persistence? Because that determines the next 6 to 12 months. So here's the fork in the road, ladies and gentlemen. This is the key part. There are only 2 macro pathways here, okay? Scenario 1, the hard Fed path. If the Federal Reserve maintains or introduces restrictive policy, real yields stay elevated, dollar strength persists. Gold remains range-bound or corrective. In this environment, gold behaves like it did in 2022 to 2023, volatile, sideways, to down-driven by liquidation cycles. But importantly, even in this scenario, structural buyers, central banks, they continue accumulating and gobbling up and buying everything, meaning the downside is absorbed over time, okay? Scenario 2, the credible shift path. Now, this is where it becomes interesting. If markets begin to believe the Fed is reacting too slowly, unable to fully contain inflation, or constrained by debt, servicing pressures, then something changes structurally. Because in that scenario, bond yields cannot rise. Bond yields can rise sometimes, but gold does not fall with them. Instead, gold begins behaving like a monetary credibility hedge, not just an inflation hedge. This is where historical analogies like the 1970s matter. When policies lagged inflation, gold didn't just rise. It re-rated. What if the next 6 to 12 months are really about? So strip away noise. The next phase of gold is not about jewelry demand, seasonal flows, or short-term sentiment. It's about real yield direction, Fed credibility, liquidity conditions, central bank accumulation persistence. And those 4 inputs determine whether this is a mid-cycle consolidation or a continuation phase paused before the breakout. So the most important insight most people miss, gold is no longer behaving like a commodity. It's behaving like a secondary monetary anchor. That means when confidence in policy is high, gold struggles. When confidence in policy is uncertain, gold thrives. And that relationship is becoming more sensitive, not less. So if you're looking at a 6 to 12 month outlook, this is not financial advice, just my own opinion, and retains organization and capacity. This is scenario based, not a forecast. Here's the structural view. Base case, most probable. Extended consolidation range, high volatility between macro headlines, gradual rebuilding of trend structure, Central banks provide downside support. Bullish acceleration case. Inflation proves sticky. Fed forced into delayed easing cycle. Real yields compress. Gold re-enters breakout structure towards new highs. Bearish pressure case. Persistent tightening expectations. Stronger dollar regime. ETF outflows continue. Gold retests deeper support zones before stabilizing. So the final structural truth, gold is not in a collapse. It's in a macro identity transition from inflation-head commodity to global monetary trust barometer. And that transition is messy. It creates false breakdowns. It creates false tops. It creates periods where nothing seems to work until everything moves all at once. That is what makes this phase so important, because the next major directional move in gold will not be driven by retail sentiment. It will be driven by policy interpretation at the highest levels of macro markets. Ladies and gentlemen, if you want to learn to trade, if you want to learn to invest, if you want to learn to take advantage of all the things that we're identifying, do come and join the Crypto Public Desk monthly and join over 570 traders and active investors. Doesn't matter where you are in your journey of learning to trade or invest, or if you're just starting your financial freedom journey now, come and join us. I want to say something, and this is not financial advice, just my own opinion or any capacity. A lot of people get disappointed about XRP. I love XRP. I love ICB. I love HBAR. Ladies and gentlemen, I call XRP the anointed one, not to have any form of religious acronyms to this. This is a slow asset to be involved in. It does nothing for a long period of time and then has a rip your face, melt your face off rally. Very much like a lot of other financial markets, it's patience. You have to wait. You have to have the tenacity of like a crocodile, an alligator. You got to sit there with your mouth open like this, not get caught up like sushi, and just wait for it. While your position size matters, while your Gucci conviction and your Gucci clarity matters, and also your mental disposition matters. Your mind is a battlefield. You must be your mind's general, not its foot soldier. Fear makes the wolf bigger. I always tell you this. Fear of loss, fear of gain. This asset moves sideways for extended periods of time, and then it explodes higher with godlike candles. You have to understand when I say you pay attention to what's quiet. Crypto's quiet right now. Most people aren't paying attention to it. Does it drift lower than here? Potentially. I like myself to purchase things on sale. I like rain checks. I like coupons. What rational person doesn't like coupons? I mean, if you've gotten to the point that you have that much money that you dislike money, hallelujah, God bless you. I don't think I'll ever get to that point that I will have no respect for certain things. As a financial mercenary, we identify trends, we pay attention to patterns. XRP is being gobbled up by the big boys for a reason. Again, I went over in other videos about why the Japanese carry trade helped me buy my first home in the early 90s. I traded that. I lived through that. I was taught on that. Understand something right now. Zero interest rate policies did not work for the Japanese. It did not work for the Europeans. It's not going to work for us. Something else is going to have to be done, and it's being done right now. We are in the camp the Clarity Act gets done. People have gone away for the summer and sold their holdings. People are looking at some big name IPOs. We're not in the camp that you should ever buy an IPO when it hits the market. You don't want to become exit liquidity. Wait for value. You work very hard for your money, ladies and gentlemen. If you want to learn how to make that money work even harder for you through trading and investing, do come and join the Crypto Public Desk monthly. You have to let things play itself out. From the videos where I started going on these rants to now, the world is changing. When Operation Put Into Win It begins, things are going to change. We believe certain people will put into place to influence markets, and we see that happening. I'm not going to give that away for free. If you want to learn that, come and join the Crypto Public Desk monthly of how we're keying off that compliance rule. And we talk about things like this through YouTube. Understand something. When the narrative changes, it changes everything. Taking the PhD at a PhD right here, the market believes high interest rates are here. and put the brake on a lot of things. Use this time wisely. That's all I'm going to say. As financial mercenaries, we don't get cut up like sushi. We feast on it. I love you all. This is not financial advice. Have a blessed afternoon. I'll see you at 7:30. And as always, this content is for information on occasional purposes only. This is not financial advice. Never invest money based on a YouTube video. I love you all. I'll see you on the front lines. I'll see you at 7:30 tonight.